welcome back to the deep dive. Today, we're going to do a deep dive into the world of Warren Buffett.
Sounds good.
You've sent us some really interesting articles about his investment strategies.
Oh, yeah.
From sources like Berkshire Hathaway shareholder letters,
Mm-hmm.
the Cooper blog,
Interesting.
the Economic Times,
Okay.
and even the Motley Fool.
Wow.
So, looks like you really want to understand how this legendary investor thinks.
Absolutely. And I think one thing that really stood out to me looking at these articles you sent
Yeah.
is that you're really interested in those three categories of businesses that Buffett talks about. The exceptional businesses,
Yeah.
the solid businesses,
Yeah.
and then the ones he just kind of steers clear of,
Right.
the risky businesses.
Yeah. So let's dive into those.
Okay.
It almost sounds like Buffett sees businesses as different types of savings accounts.
You know, it's a brilliant analogy.
Really?
He actually compares exceptional businesses to a savings account with an incredibly high interest rate,
Okay.
one that just keeps growing.
Oh, so you just keep getting richer and richer without having to lift a finger.
Not so fast.
Okay.
You have to find these exceptional businesses first,
Right.
and that's where things get a little bit tricky.
Okay.
One of the things that Buffett looks for
Yeah.
is what he calls a strong economic moat.
Okay. Now, an economic moat, is that like some kind of medieval castle defense system for businesses?
You know, it's surprisingly accurate.
Okay.
Think of a castle surrounded by this deep,
Yeah.
wide moat.
Mm-hmm.
It's a really powerful defense, right?
Right.
Well, in the business world, an economic moat is a unique advantage that a company has
Okay.
that protects its profits
Mm-hmm.
and it fends off competitors.
Okay.
So it could be a powerful brand,
Uh-huh.
unique technology,
Okay.
cost advantages,
Mm-hmm.
things that make it really, really hard for other companies to compete with them.
So like Apple's brand loyalty would be a moat?
Exactly.
Or maybe Amazon's massive logistics network.
Exactly. And the Cooper blog actually goes even deeper and breaks down different types of moats.
Really?
They talk about intangible assets like brands
Mm-hmm.
and patents.
Mm-hmm.
Then there's cost advantages
Yeah.
like economies of scale
Okay.
and even things like switching costs where it's just too much of a hassle for a customer to switch to a competitor.
Okay. That makes sense.
Mm-hmm.
So these exceptional businesses are like these impenetrable fortresses
Yeah.
consistently generating these high returns.
Yes.
And they need very little reinvestment.
Right.
It's fascinating that Buffett uses examples like See's Candies.
Uh-huh.
I mean, everybody loves chocolate,
Hmm.
but I never really thought about it as an investment powerhouse.
Yeah, what's fascinating about See's Candies is that it generates really high returns
Okay.
without needing much reinvestment.
Right.
And then that excess cash
Yeah.
can be deployed to buy other businesses.
Oh.
So it creates a compounding effect.
That's really smart.
Mm-hmm.
So where do companies like Geico and Costco fit in? I know Buffett's a big fan of both of them.
They're textbook examples of what Buffett calls low-cost producers.
Okay.
Their economic moat is their ability to offer lower prices than their competitors
Right.
while still being incredibly profitable. It's
Right.
like a superpower.
So they've figured out how to offer value and make a ton of money at the same time.
Yeah.
What about companies like Coca-Cola or American Express?
Those are great examples of businesses with incredibly strong brand moats.
Okay.
I mean, just think about it. Coca-Cola is practically synonymous with cola.
Right.
They can charge a premium for their product because of that powerful brand recognition and that customer loyalty.
Yeah.
American Express has cultivated this image of exclusivity and premium service,
Right.
and that translates into a willingness from customers to pay higher fees for their cards.
Wow. Never really thought about it like that.
Yeah.
So these companies are practically untouchable.
That's the power of a strong economic moat.
Okay.
But remember, not all businesses are created equal. Some require a little more attention, and that's where those solid businesses come in.
Okay, so bring on the solid businesses.
All right.
I'm guessing these are a bit more like my savings account.
Mm-hmm.
Decent interest, but I have to keep adding to it to see real growth.
That's a great way to think about it.
Okay.
Solid businesses can still be very profitable,
Yeah.
but they might need more reinvestment
Right.
to maintain or grow their earnings.
Okay.
They might not have that unreachable moat,
Right.
but they're still in a pretty good position.
So they're strong, but they need a little extra care and feeding.
Yeah.
Okay. I'm all about a low maintenance investment.
Sure.
But maybe some of these solid businesses are worth the extra effort.
Yeah.
Before we move on to those, though, you mentioned that the Economic Times article had a really interesting take on how this whole system might have a flaw.
It does.
Wow.
But I think to really understand that critique,
Yeah.
we need to understand the last category first. The one that Buffett says to avoid the risky businesses.
Okay, so let's unpack those risky businesses.
All right.
These are like the savings account with the terrible interest rate.
Yes.
Where you just keep throwing money in.
Right.
And you never see a real return.
Exactly. And sometimes you even lose money.
Oh, no.
Risky businesses often appear really promising at first, maybe even experiencing rapid growth, but they require this constant capital infusion just to stay afloat.
Okay.
They might be in really highly competitive industries, or they just lack a clear path to profitability.
Okay, this is making me a little nervous about my own investment portfolio.
I understand.
But before I panic,
Yeah.
you mentioned a specific example that Buffett himself learned from.
Right. Buffett has historically been very wary of the airline industry.
The airlines?
Yeah. And for good reason.
Okay.
They're notorious for requiring huge amounts of capital.
Planes, fuel maintenance, all that.
All of that, exactly.
Yeah.
But they often struggle to turn a consistent profit. Wow.
And Buffett experienced this firsthand with his investment in U.S. Air preferred stock back in the 80s.
Oh, right.
Mm-hmm.
Didn't he say that U.S. Air went bankrupt twice after Berkshire Hathaway sold their shares?
Yes.
Even though they made a profit initially?
Yeah, it was a real cautionary tale for him.
Wow.
And I think a great lesson for anyone thinking about investing in businesses with constant capital needs and low returns.
Okay, so now I'm really curious about this potential flaw that the Economic Times article points out. Could it be that some of these risky businesses actually have the potential to become those exceptional businesses down the road?
You're getting ahead of me, but we'll definitely discuss that.
Okay.
But first, I think we need to take a closer look at a few specific examples to really illustrate these three categories.
Okay, I'm all ears. Let's hear about some real-world examples.
Okay.
I want to understand how to spot these companies in the wild.
Let's do it. So let's start with those exceptional businesses.
We already touched on See's Candies, but I think it's worth revisiting.
Okay.
It's the perfect example of a business that generates those high returns without needing much reinvestment.
It's a chocolate cash cow.
It is.
Okay, so what about those low-cost producers like Geico and Costco?
Those are classic Buffett picks.
Yeah.
They have that built-in advantage because they can offer those lower prices than their competitors and still make a healthy profit.
It's like having a secret weapon in the business world.
It is.
And then there are those brand powerhouses.
Yes.
Coca-Cola, Gillette, American Express.
Oh, yeah.
I mean, their brands are practically synonymous with their products. Those moats are incredible.
They are. It's like a superpower.
Yeah.
That translates into consistent profits.
Okay, now for a solid business example.
Okay.
What do you got?
Buffett often uses the example of flight safety.
Flight safety.
It's a flight training company.
Oh, that makes perfect sense.
Yeah.
It's a specialized service. And they probably need to keep investing in new simulators and technology as the aviation industry evolves.
Exactly. They have a really strong market position.
Right.
But they need significant reinvestment to keep growing.
Okay. All right. Now back to those risky businesses.
Okay.
We talked about the airlines.
Yeah.
But what other industries might fall into this category?
Well, in recent years, some analysts have questioned Buffett's large investments in the tech sector.
Tech?
Yeah, companies like Apple,
Oh, wow.
Amazon, and Snowflake.
Interesting.
They've experienced this rapid growth, but they also require massive capital expenditures to maintain that growth.
Okay, this is where it gets interesting. It sounds like what might be considered risky today could potentially become a solid or even an exceptional business in the future.
You're on the right track.
Okay.
The lines between these categories can be a bit blurry, especially in a rapidly changing market.
So how do we make sense of all of this? I mean, how can we as investors use these categories to make smarter decisions?
That's a great question. Buffett emphasizes focusing on two key factors when you're evaluating any business.
Okay.
The return on capital and the need for reinvestment.
Okay.
The sweet spot is finding those companies that generate those high returns with very minimal reinvestment, like those exceptional businesses.
So it's about finding those companies that can turn their earnings into even more earnings.
Yes.
Without constantly needing these huge cash injections.
Exactly.
That's the dream.
It is.
But keep in mind, solid companies
Yeah.
can still be worthwhile investments,
They can.
especially if their returns justify the capital they need to reinvest.
Right.
So when we're looking at a company, We need to dig deep into their financials.
Yes.
Understand their competitive landscape.
Uh-huh.
Get a sense of their future capital needs.
Absolutely. And remember, Buffett's 3 categories aren't set in stone.
Okay.
A company's position can change based on industry trends, technological advancements, and even management decisions.
Okay, so it's like a dynamic chessboard where you constantly need to evaluate and adjust your strategy.
Exactly.
This is incredibly helpful. But I'm curious about those shareholder letters from Berkshire Hathaway.
Yes.
The ones you sent over are pretty dense.
They are.
What kind of nuggets of wisdom can we mine from those?
Oh, those are pure gold.
Okay.
In those letters, you'll find Buffett going even deeper into his investment philosophy,
Okay.
giving specific examples of companies he's bought or sold,
Right.
explaining the rationale behind his decisions.
Oh.
It's like getting a sneak peek into the mind of one of the greatest investors of all time.
I'm ready to dive in.
Let's do it.
Let's see what other insights we can uncover.
There's a whole world of wisdom waiting for us in those letters.
Awesome.
We'll break down how to spot those exceptional and solid businesses.
Okay.
And maybe even understand why Buffett seems to be bending his own rules with some of his recent tech investments.
All right, let's do it.
Okay.
All right, let's crack open these shareholder letters. I'm ready to unlock the secrets of the Oracle of Omaha.
Well, get ready for some serious wisdom. One of the things that really jumps out in his 2007 letter is how Buffett sees investing not just as buying stocks, but as buying a piece of a business.
So he's not chasing stock prices or following the latest trends. He's looking for companies he believes in for the long haul.
Exactly. He wants to understand the business inside and out, its competitive landscape and its potential for long-term earnings. It's about partnering with companies that are building something of real value.
Okay, that makes sense. It's about finding companies with a real and sustainable competitive advantage. It reminds me of what we were talking about earlier with those economic moats.
You got it.
Yeah.
He often uses this great analogy. He wants to own businesses that even a ham sandwich could run.
Wait, a ham sandwich? Is he serious?
He is. And it's a brilliant way to illustrate his point. He's saying that the business model itself should be so strong, so well established, that even with mediocre management, it would still thrive. The Cooper blog actually uses the example of Coca-Cola to demonstrate this. No matter who's at the helm, people are still going to crave that sugary goodness.
Okay, that's a pretty vivid image. So even with average leadership, these companies would still be successful because of their inherent strengths. But how do you even find these ham sandwich businesses?
Well, that's what's so great about these letters. You get to see how Buffett thinks. He breaks down entire industries, dissects financial statements, even shares anecdotes about his interactions with company management.
It's like we're getting a masterclass in business analysis and investing.
Exactly. And he doesn't sugarcoat things. He emphasizes the importance of reading and understanding those often dreaded financial reports, thinking independently, and not getting swept up in the market hype.
It sounds like he's really advocating for doing your own homework, forming your own opinions, and having the conviction to stick to your strategy even when the market gets crazy.
Absolutely. He warns against following the herd and instead encourages investors to be patient and disciplined, especially when everyone else is panicking.
I can see how that would be tough.
Yeah.
It's so easy to get caught up in the fear of missing out, especially in today's market where everything moves so fast.
It's definitely a challenge, but Buffett's a big believer in the idea that investing is a marathon, not a sprint.
That makes a lot of sense when you think about his track record.
Yeah.
He's been in the game for decades, and I've heard he has this knack for finding those undervalued companies that other investors might overlook.
Right. He's famous for finding those cigar butts companies that might not be the most glamorous or exciting, but still have some value left in them.
It's like finding hidden treasure in plain sight. But how does this all apply to today's market? Things are changing so rapidly, with technology disrupting practically every industry.
That's a great question, and it's something Buffett addresses in his more recent letters. He acknowledges that some traditional moats might not be as strong as they used to be.
So even those strong brands and cost advantages might not be enough in the face of technological disruption.
Exactly. He's been more cautious about investing in industries facing massive upheaval. Think about how the internet has transformed retail, for example. Some of the giants of brick-and-mortar stores struggle to adapt.
So he's not afraid to adapt his thinking as the world changes.
Absolutely. And this is where it gets really interesting, because despite his cautious approach to certain tech companies, he's made significant investments in companies like Apple and Amazon.
That seems to contradict his earlier stance. What's going on there? Is he bending his own rules?
Well, I think it's more nuanced than that. Remember, Buffett is a pragmatist. He's willing to adapt his thinking as the world changes. And the world has changed dramatically with the rise of the internet and the explosion of technology.
That's true. We talked earlier about how he's acknowledged that some traditional moats might not be as strong as they used to be, especially in the face of tech disruption.
Exactly. So while he's still cautious about industries facing massive upheaval, he also recognizes that some of the most exciting opportunities are emerging in the tech sector.
So it's not that he's abandoning his principles, he's evolving them. He's applying those same core principles of value investing to a new landscape.
I think that's a great way to put it. He's still looking for companies with a durable competitive advantage, strong management teams, and a clear path to profitability, but those factors might manifest differently in the tech world.
So instead of looking for companies with a history of steady earnings and dividends, he's looking for companies with the potential to dominate massive, rapidly growing markets.
Precisely. And that's where companies like Apple and Amazon come in. They might not fit the traditional mold of a value stock, but they have built incredibly powerful platforms with massive network effects.
Right. Think about how many people use iPhones and shop on Amazon. Those are habits that are incredibly hard to break. That's a kind of moat in itself.
It absolutely is, and I think that's what Buffett is recognizing. He's looking for companies that are building the future, companies that are creating new categories and reshaping entire industries.
And he's willing to bet that the potential rewards outweigh the risks.
Exactly. And let's not forget that he's not putting all his eggs in one basket. He's still maintaining a diversified portfolio with a mix of those classic, exceptional, and solid businesses, as well as these more speculative tech investments.
So it's about finding that balance, right?
Yeah.
Sticking to those core principles of value investing, but also being open to new opportunities and new ways of thinking about value.
I think that's a great takeaway from all of this. The world of investing is constantly evolving, and the most successful investors are those who can adapt and evolve along with it.
This has been an incredible deep dive. I feel like we've not only gained a deeper understanding of Warren Buffett's investment strategies, but we've also learned how to apply those principles to today's rapidly changing market.
I agree. And I think the most important takeaway is that investing is a journey of continuous learning. It's about staying curious, asking questions, and always seeking to expand your knowledge and understanding.
Exactly. And who knows, maybe someday we'll be the ones sharing our investment wisdom with the world.
Well, maybe we should hold off on that for now. But I do think we've unearthed some really valuable insights today. Thanks for taking this deep dive with me.
It's been a pleasure. And remember that one nagging question we haven't fully addressed? What about that potential flaw that the Economic Times article pointed out? Could it be that some of those risky businesses we talked about actually have the potential to become the exceptional businesses of tomorrow?
That's a fantastic question, and I think it's the perfect segue into discussing one of the most fascinating and hotly debated aspects of Buffett's recent investment strategy. Are you ready to dive into the world of tech and see if Buffett's breaking his own rules?
I'm ready. Let's unpack this tech conundrum and see what we can learn. Okay, so we spent all this time talking about Buffett's more classic investment strategies, those exceptional businesses with their strong moats, the solid ones that maybe need a little more attention,
Yeah,
and then those risky ones he usually just kind of avoids.
right.
But then you mentioned this Economic Times article
Yeah,
that's kind of throwing a wrench in the whole system.
right.
They seem to think some of the businesses that Buffett might call risky
Mm-hmm.
could actually become like the superstars of tomorrow.
Yeah, that's a great question, and it is where things get really interesting.
Yeah, because on the surface,
Yeah.
some of Buffett's recent moves,
Mm-hmm.
especially in the tech sector,
Right.
they seem to kind of contradict his long-held principles.
Yeah.
I mean, we've talked about how much he loves these steady, reliable businesses,
Right.
the ones that are just generating cash like clockwork.
Yeah.
But then he goes and makes these big bets on companies like Apple, Amazon,
Yeah.
Snowflake.
Mm-hmm.
You know, these are companies that are all about growth and innovation and disrupting entire industries.
Exactly.
So what's going on here?
Yeah.
Is he just changing his tune?
Well,
Did he finally decide to embrace the high-growth, high-risk world of tech?
I think it's a little more nuanced than that.
Go ahead.
I think you have to remember that Buffett is a pragmatist.
Go ahead.
I mean, he's willing to adapt his thinking as the world changes.
That's true.
And the world has changed pretty dramatically
I guess-
with the rise of the internet and this explosion of technology.
Right. I mean, we were talking earlier about how he's even admitted that some traditional moats might not be as strong as they used to be,
Right.
especially as tech is disrupting things.
Especially in the face of all this disruption. Yeah.
Yeah, so while he's still cautious about industries that are facing massive upheaval, he also seems to recognize that some of the most exciting opportunities are emerging in tech.
Right.
So it's not that he's abandoning his principles.
Yeah.
He's just kind of evolving them.
Exactly.
He's applying those same core principles of value investing, but in a new landscape.
I think that's a great way to put it. He's still looking for those companies with a durable competitive advantage, strong management teams, a clear path to profitability. But those factors might look a little different in the tech world.
So instead of looking for companies with a history of steady earnings and dividends, he's looking for companies that have this potential to just dominate these massive, rapidly growing markets.
Exactly. And that's where companies like Apple and Amazon come in. I mean, they might not fit that traditional mold of a value stock. But they've built these incredibly powerful platforms.
They have.
With these massive network effects.
Yeah, just think about how many people use iPhones or shop on Amazon.
It's hard to imagine life without them now.
Right. Those are habits that are really hard to break.
Exactly.
And that's like a moat in itself.
It absolutely is. And I think that's what Buffett is recognizing.
Okay.
He's looking for the companies that are building the future, the companies that are creating new categories and reshaping entire industries.
And he's willing to bet that the potential rewards are going to outweigh the risks.
Exactly. And let's not forget that he's not putting all of his eggs in one basket.
Right.
He's still maintaining a diversified portfolio with a mix of those classic, exceptional, and solid businesses, as well as these more speculative tech investments.
So it's about finding that balance.
I think so.
Right? Sticking to those core principles of value investing. But being open to new opportunities and new ways of thinking about value.
I think that's a great takeaway from all of this.
Okay.
The world of investing is constantly evolving.
It is.
And the most successful investors are going to be the ones who can adapt.
And evolve along with it.
Right.
Well, this has been an incredible deep dive.
It has been fun.
I feel like not only have we gotten a better understanding of how Warren Buffett thinks about investing, but we've also learned how to apply those principles to today's market, which is changing so rapidly.
It is. And I think the most important takeaway for me is that investing is this journey of continuous learning.
Yes.
It's about staying curious, asking questions, and always seeking to expand your knowledge.
And understanding.
And understanding, exactly.
And who knows, maybe someday we'll be the ones sharing our investment wisdom with the world.
Well, maybe we should hold off on that for now. But I do think we've unearthed some really valuable insights today.
Yeah.
Thanks for taking this deep dive with me.
It's been a pleasure. And for our listener,
yes,
I hope this deep dive has given you a whole new perspective on Warren Buffett and the world of investing.
I hope so.
Remember, it's not just about following someone else's playbook.
Right.
It's about developing your own investment philosophy.
Yeah.
One that's grounded in sound principles, but also flexible enough to adapt to an ever-changing world.
Exactly.
So keep learning.
Keep exploring.
And happy investing.